Hi everyone, this is Steven with SJ Lincoln Realty in Ballston Spa, New York, and the topic of today's video is why you should own apartment buildings. When I first mention to people that I own rental property, I get one of two responses: either, wow, that must be nice just to have checks show up in the mail every month, or, ugh, don't you always get calls in the middle of the night to fix squeaky faucets and plunge toilets? Well, just like with many things, the truth lies somewhere in the middle. Over the next few minutes, we'll touch on 4 of my favorite reasons to own rental property. Let's get started. Great, so as mentioned in the introduction, we'll be taking a look at rental properties today. Again, my name is Steven Lutman. I'm a real estate broker and owner of apartment buildings for the better part of a decade. There will be 4 major buckets we'll be taking a look at today. Those are going to be cash flow, appreciation, tax benefits, and personal development / knowledge. Cash flow is where we're going to start, and that's just a fancy term for how much money you're left with at the end of a given period. The example we'll work with today is going to be a 3-unit apartment building. Each of the 3 apartments brings in $1,000. That is going to be our income. Our expenses, first and foremost, is going to be our mortgage expense, so that's going to be your principal and interest, plus your property taxes and insurance to protect the building. We're going to estimate those at $1,750 per month. We're going to set aside $300 for maintenance and capital expenditures, and we're going to ballpark our vacancy at 5% of rents, which will be $150. So in order to calculate our monthly cash flow, it's going to be income minus expenses. So we're going to have $3,000 as income, and we're going to back out from that number the mortgage, the taxes and insurance, the maintenance and the vacancy, which leaves us with a positive monthly cash flow of $800. Now, not all buildings you'll look at will have positive cash flow. You also need to take a look at what our next category is going to be, appreciation. That also plays a role. However, if you are comparing similar properties, maybe there's another 3-unit building you're also interested in down the street, comparable rents, comparable size, you can do a quick calculation on the cash flow, and that will give you direction on which investment might be best given the options presented to you. Whereas cash flow is a fairly simplistic calculation, appreciation is a little bit more tricky to wrap our arms around, but the best way to think of it is what is our asset worth today versus what it was worth when we initially acquired it. So here we have the CoreLogic Case-Shiller Home Price Index. This is something that's widely circulated on a monthly basis and tracks what United States home prices are doing over a month basis. So we do have a trough of a little bit over 1% and peaks closer to 6%. However, if you were to average that out, you're in the 4% neighborhood. So what does that mean on a numerical basis? Well, let's take a look at a purchase price of $200,000. Here we have 3 different time horizons: 5 years, 15 years, and 30, depending on what you thought the market was going to do going forward, whether it be underperform at 2% or overperform at 6%, or possibly just remain still at 4%. You can kind of gauge out what that $200,000 purchase would look like down the road. Now, we don't know what the market is going to look like year over year. However, just historically, we can kind of ballpark what we think it's going to look like. So again, given a 15-year time horizon and an outperforming market, your home value would be right around $479,000. So that's what it looks like on the appreciation side of the home itself. However, as rental property owners, we also get the benefit of appreciation in rents. So here we have a chart going back to 2005. That again is going to tell us historically what we could expect to see as rental property owners. And we can see, sure, there are some peaks and troughs in there, but we could bank on right around 2 to 3% of rent appreciation. So again, not only are we getting growth on what the property is worth, but we're also gaining on what rent's coming in every month, which then in fact is going to impact the last bucket that we looked at, being cash flow. So we are getting the best of both worlds there. The next topic we'll move to are the tax benefits of owning rental property. I'll preface this portion of the video by saying I'm not a CPA, so make sure you have a qualified tax professional on your team heading into any type of a purchase. With that said, there are a few keywords you'll want to familiarize yourself with. These are deductions, depreciation, and capital gains. We discussed income a few moments ago. While the IRS allows us to reduce our taxable income with what are known as deductions, money spent to advertise a vacant apartment, having one of your units freshly painted, these are examples of expenses that could be used as deductions. Depreciation is the process of deducting an expense over its useful life instead of all at once. Going back to our example of the $200,000 purchase, we'll say the building itself is valued at $150,000 and the land which it sits makes up the remaining $50,000. For real estate, the IRS says useful life is 27 and a half years, meaning we are entitled to approximately $5,500 of annual depreciation expense. Remember, we want to limit our taxable income, and depreciation allows us one avenue to do so. Finally, we want to get a feel for capital gains. Specifically, as rental property owners, we're interested in long-term capital gains. An asset held for over a year prior to sale is classified as a long-term gain. Depending on your income, the tax rate on long-term capital gains will be either 0, 15, or 20%. This compares favorably with rates on ordinary income, think of your W-2 job, which can be as high as 37%. The key takeaway is not all income is created the same. The old adage, it's not what you make, but what you keep is important, certainly applies here to rental properties. As mentioned during the intro, I've owned rental property for close to a decade, and I've put together a brief list of some life skills and overall development I've experienced over the years. If there are items on here that make you uncomfortable, don't let that discourage you. What's great about this business is you can do as much or as little of the day-to-day as you want. The one caveat to that being, just make sure you're good at hiring competent team members who can pick up the slack on any items that you wish to delegate.
So that'll wrap up today's video. If you have any questions or would like something discussed further, go ahead and let me know in the comment section below. If you live in the capital region and are interested in buying or selling real estate, you can schedule a phone call with me. If you're watching this on YouTube, there will be a link in the description. Or if you have to be viewing this on Facebook, there will be a contact me now button similarly below this video as well. And I'm happy to jump on a call, discuss what the current market looks like and what your expectations are. Again, really appreciate everyone watching today. Thanks for taking the time and look forward to connecting with you all shortly. Thanks.